Most beginners believe investing is about finding the next stock that will explode. It is not. Successful investing is usually much less exciting. It is about controlling risk, investing consistently, and allowing time to multiply your money. The biggest danger for a beginner is not starting with too little money. It is starting without understanding what you are doing. In this video, I will show you 8 practical investing rules that can help you avoid costly mistakes, choose suitable investments, and begin building wealth, even if you can only start with a small amount. And stay until the end, because I will give you a simple 7-day plan for making your first investment responsibly. Before we begin, remember that this video is for education and general information. It is not personalized financial advice. Every investment involves risk, and your decisions should reflect your financial position, goals, country, taxes, and tolerance for loss. Investing is not gambling when it is based on ownership, diversification, research, and a long-term plan. But it can become gambling when you chase hype, borrow money to speculate, or invest in something you do not understand. Let us begin with the foundation most beginners ignore. Tip 1. Your finances before investing. Investing should not be the first step in your financial journey. Before investing aggressively, examine 3 areas: your monthly expenses, your emergency savings, and your expensive debt. Start by creating a basic budget. You need to know how much money comes in, how much goes out, and how much you can invest without struggling to pay essential bills. Next, establish an emergency fund. An emergency fund is money kept in an accessible savings account for unexpected expenses, such as medical bills, job loss, urgent travel, or major repairs. Many financial educators suggest building enough to cover approximately 3 to 6 months of essential expenses. Your appropriate amount may be different, particularly if your income is irregular or several people depend on you. Without emergency savings, a financial crisis may force you to sell investments at the worst possible time. You should also review high-interest debt, especially credit card debt. If a debt charges an extremely high interest rate, paying it down may offer a more predictable financial benefit than investing while the interest continues accumulating. Do not build an investment portfolio on a weak financial foundation. Tip 2. Give every investment a purpose. Before choosing an investment, ask one important question. What exactly is this money for? Your answer determines how much risk you can reasonably take. Money needed within the next year or two, such as rent, tuition, business expenses, or an emergency reserve, generally should not be exposed to highly volatile investments. The market does not care when your school fees are due. For a medium-term goal, you may require a more balanced approach. For goals that are many years away, such as retirement or long-term wealth creation, you may have more time to recover from temporary market declines. Write down 3 things: your goal, the amount you want to reach, the date when you will need the money. Your investment should serve your goal. Your goal should not be changed simply because an exciting investment appears on social media. Tip 3. Start early, even if you start small. Many beginners delay investing because they believe they need thousands of dollars. You do not need to begin with a large amount. You need an amount you can contribute consistently. The real advantage is time. Compound growth occurs when your original investment earns a return, and future returns are earned on both your original money and the previous growth. Consider a hypothetical example. Imagine investing $100 every month at an average annual return of 7%. After 20 years, the account could grow to approximately $52,000. You would have contributed only $24,000 yourself. Continue for 30 years, and the account could reach approximately $122,000, while your personal contributions would total $36,000. This is only a mathematical illustration. It does not include taxes or fees, and a 7% return is not guaranteed. But the lesson is powerful. The additional 10 years contribute more than another 10 years of deposits. They give the earlier money more time to compound. Your first investment may appear insignificant. Its greatest asset is not its current size. Its greatest asset is the number of years ahead of it. Start with what you can afford. Increase it when your income improves. Tip 4. Understand what you are buying. Never invest solely because someone says, this is going up. Before buying anything, understand what you are purchasing. A stock represents partial ownership in a company. Its value may rise when the company grows and investors become more optimistic. It may also decline significantly if the company performs poorly. A bond generally represents money lent to a government, company, or other issuer. In exchange, the issuer promises interest payments and repayment under specified conditions. Bonds still carry risks, including default, inflation, and interest rate risk. A mutual fund pools money from multiple investors and purchases a collection of investments. An exchange-traded fund, commonly called an ETF, can also hold a collection of assets, but its shares are generally traded on an exchange during the trading day. Funds can make diversification easier, but not every fund is diversified. A fund may concentrate on one industry, country, commodity, or speculative theme. Before investing, answer these questions. What does this investment own? How does it generate returns? What could cause it to lose value? What fees will I pay? How easily can I withdraw my money? Is it regulated in my jurisdiction? If you cannot explain the investment in simple language, continue researching before investing. Tip 5. Diversify instead of trying to find one winner. Imagine investing all your money in one company. If that company succeeds, you may earn a significant return, but if it fails, your financial plan may fail with it. Diversification means spreading your money across different investments so that the performance of one company or sector does not determine your entire result. You can diversify across different companies, different industries, different countries, different asset classes, and, where appropriate, different investment styles. Broad market index funds and diversified ETFs are popular tools because one fund may hold shares in hundreds or even thousands of companies. However, owning many funds does not automatically mean you are diversified. 5 funds may all own many of the same technology companies. Always examine the underlying holdings. Diversification cannot prevent every loss. During major market declines, many assets may fall together. Its purpose is to reduce unnecessary concentration risk, not to eliminate risk completely. For most beginners, building a diversified system is more dependable than attempting to predict one spectacular winner. Tip 6. Automate your investing. One of the most effective investing decisions is removing emotion from the process. You can do this by automatically investing a fixed amount on a regular schedule. This approach is commonly associated with dollar-cost averaging. For example, instead of waiting for the perfect market price, you might invest $50, $100, or another affordable amount every payday or every month. When prices are high, your fixed contribution buys fewer units. When prices are lower, it buys more units. This does not guarantee a profit or protect you from every loss. It also does not mean gradually investing existing cash will always outperform investing it immediately. Its main benefit for many beginners is behavioral. It creates consistency. You stop asking, is today the perfect day? You begin following a system. During frightening markets, consistency becomes difficult, but market declines are not unusual interruptions to investing. They are part of investing. Set an amount you can sustain during both good and difficult months. A smaller contribution maintained consistently may be better than an unrealistic amount abandoned after 3 months. Tip 7. Take fees seriously. Investment fees often appear small because they are shown as percentages, but fees compound in the opposite direction. Instead of helping your money grow, they repeatedly reduce the amount remaining in your account. Possible costs include trading commissions, fund expense ratios, account maintenance charges, advisory fees, currency conversion costs, withdrawal charges, taxes, and spreads between buying and selling prices. When comparing 2 similar funds, examine their objectives, holdings, risks, performance methodology, and total costs. Do not select an investment only because it has the lowest fee. A cheap investment can still be unsuitable. But when 2 investments provide similar exposure, consistently paying substantially more may reduce your long-term result. Read the fund documents. Review your broker's fee schedule. Understand the taxes that apply in your country. Every amount removed in fees is money that can no longer compound for you. Tip 8. Control your behavior. Your behavior may affect your results more than your ability to analyze complicated charts. Beginners commonly make 5 emotional mistakes. Buying after an investment has already become extremely popular. Selling everything during a temporary decline. Checking prices constantly. Changing strategies every few weeks. And confusing confidence with competence. Financial markets produce endless information. Most of it does not require an immediate response from you. Before investing, write down your rules. What are you investing for? How often will you contribute? What level of decline can you tolerate? When will you review the portfolio? Under what conditions would you sell? A written plan creates distance between your emotions and your decisions. You do not need to react to every headline. You need a strategy that remains reasonable when headlines become frightening. Recognize investment. Beginners are frequent targets of investment fraud because scammers know they are searching for guidance. Be cautious when someone promises guaranteed high returns, profits without risk, secret opportunities, pressure to invest immediately, unexplained trading systems, exclusive access available for only a few hours, or requests to transfer money into a personal account or unknown wallet. Verify the company, platform, and investment professional through the appropriate regulator in your country. Never treat popularity as proof of legitimacy. Followers can be purchased. Testimonials can be fabricated. Screenshots can be edited. A legitimate investment should survive careful research. If someone becomes angry because you want time to verify the opportunity, protect your money and walk away. Your beginner framework does not need to be complicated. First, stabilize your finances. Second, define your goal and time horizon. Third, choose regulated investments you understand. Fourth, diversify appropriately. Fifth, automate affordable contributions. Finally, review the plan periodically instead of reacting daily. A beginner does not need 15 trading indicators, 20 applications, and 40 investments. You need a clear goal, a manageable portfolio, and disciplined behavior. The 7-day starting plan. Here is your 7-day action plan. Day 1. Calculate your monthly income, essential expenses, and existing debt. Day 2. Set an emergency fund target. Day 3. Choose one financial goal and write down its target date. Day 4. Learn the difference between stocks, bonds, mutual funds, and ETFs. Day 5. Research regulated investment platforms available in your country. Compare their fees, protections, and withdrawal processes. Day 6. Study one diversified investment that aligns with your goal. Read its objective, holdings, risk information, and costs. Day 7. Decide on an affordable recurring amount. Begin only after you understand what you are buying. Do not measure success by whether your investment rises next week. Measure success by whether you created a responsible process that you can maintain for years. Investing is not a shortcut to instant wealth. It is a method for allowing disciplined decisions, productive assets, and time to work together. Build your financial foundation. Invest with a purpose. Start early. Understand what you own. Diversify. Automate. Control fees. And protect your decisions from fear, greed, and hype. Your advantage as a beginner is not that you know everything. Your advantage is that you can develop the right habits before expensive mistakes become permanent habits. If this video helped you understand investing, subscribe to the channel and share it with someone who wants to begin building wealth. Then comment below, what is the first financial goal you are investing for? Your future portfolio begins with the decision you make today. The emergency fund, goal setting, and cost guidance reflects FINRA's September 2025 recommendations for new investors. FINRA, diversification and passive investing principles are consistent with FINRA's May 2025 investor guidance. FINRA, the discussion of recurring contributions reflects FINRA's 2026 explanation of dollar cost averaging, including its limitations. Syndication. The warning about fund expenses reflects the SEC's July 2025 Investor Bulletin, which explains that fees directly reduce investment returns. SEC. The compounding illustration assumes monthly contributions of $100 and a hypothetical 7% annual return, producing approximately $52,093 after 20 years and $121,997 after 30 years. Returns are not guaranteed. If you found this video helpful, don't forget to like, subscribe, and share with someone who wants financial freedom. Thanks for watching, and I will see you in the next video.